In this last section, we're going to briefly cover ethics, practices, and procedures as a tax preparer. We'll consider paid preparer penalties for different tax positions, as well as the record-keeping and filing obligations and penalties that may apply. Since the AFSC designation contemplates a separate ethics course requirement, this is going to be the shortest section of the course, and we're really going to focus more on the practices and procedures of tax preparers rather than have a really strong emphasis on ethics, although we'll cover it as it's a recommended topic for this course. IRC section 6694A sets forth a preparer penalty for returns where there is an understatement of liability based on an unreasonable position. The language of the statute is as follows. If a tax return preparer prepares any return or claim for refund with respect to which any part of an understatement of liability is due to an unreasonable position and knew or reasonably should have known of the position, such tax return preparer shall pay a penalty with respect to each such return or claim in an amount equal to the greater of $1,000 or 50% of the income derived or to be derived by the tax return preparer with respect to the return or claim. So there are four key elements that must be met for this statute to apply. First, you need a tax preparer, and that sounds really simple, but there's actually some nuance there because a tax preparer is somebody who prepares a tax return for compensation. If they do not prepare a return or claim for refund for compensation, they are not a tax preparer. They're just somebody who was nice and helped somebody else out. Two, they need to prepare a return or claim for refund with an understatement of liability. If there is no understatement of liability, then there cannot be a violation of this particular statute. Two, where the understatement of liability is due to an unreasonable position, and we're going to spend a lot of time on what an unreasonable position is and how you differentiate between that and a reasonable position. And lastly, four, the taxpayer must have known or should have known that the position was unreasonable. The regulations indicate that the definition of a tax preparer in IRC section 7701 applies. IRC section 7701A36 defines a taxpayer as any person who prepares for compensation or who employs one or more persons to prepare for compensation any return of tax imposed by this title or any claim for refund of tax imposed by this title. The statute also includes any person who prepares a substantial portion of such return or claim for refund, even if that preparer doesn't sign the return. However, the statute also specifically excludes individuals who merely provide typing or photocopying assistance in tax preparation, or who prepare a return for their employer. Basically, any person preparing a return for compensation is a tax preparer, and the statute applies to them, unless they're compensated as an employee. An understatement is specifically defined in section 6694E as any understatement of the net amount payable with respect to any tax imposed by this title, or any overstatement of the net amount creditable or refundable respect to any such tax. In other words, the statute applies to all understatements of tax, not just significant understatements exceeding a certain material threshold amount. While 6694 only mentions a return or claim for refund in its plain language, the regulations indicate that this also applies to the preparation of an amended or adjusted return. The determination of whether the taxpayer knew or should have known that the position was unreasonable is generally a fact-based determination based on the individual knowledge and expertise of the tax preparer. For instance, if the tax preparer didn't know nor should have known that the position was unreasonable, then the good faith defense discussed later would generally be available. An unreasonable position is also defined in the statute. The general rule is that an unreasonable position is a position that lacks substantial authority. However, if a position is disclosed on a return, then it is unreasonable only if it lacks a reasonable basis, which is a lower standard than substantial authority. Alternatively, if the position is with respect to a tax shelter or a reportable transaction, then the position is unreasonable unless it is reasonable to believe that it would more likely than not be sustained on its merits, which is again a higher standard than substantial authority. It's also nearly impossible to prove that a tax shelter would be sustained on its merits, particularly after it's not sustained on its merits, because again, you're only dancing in this area of the law if there was an understatement of tax in relation to this particular position. So, you know, a nearly impossible standard to meet. Basically, if there's a tax shelter or a reportable transaction, it's almost certainly unreasonable. So since reasonable basis is the lowest standard where penalties won't apply, and that's the case if there's a reasonable basis and there's a disclosure, we're going to start with this lowest standard. Reasonable basis is still a relatively high standard of tax reporting, and it's not satisfied by a return position that is merely arguable or colorable. There was a standard that once was more relevant than it is today, and that was that a tax position was not frivolous, and that would be lower than a reasonable basis. But that standard, if a position is merely not frivolous, that doesn't really get you anywhere for purposes of these penalties. A return position meets the reasonable basis standard if it is reasonable based on a primary authority, such as the Internal Revenue Code, Treasury regulations, court cases, the legislative history for the tax code, revenue rulings, revenue procedures, PLRs, and technical advice memorandums. So if it's reasonable based on one of those primary authorities, then it may have a reasonable basis. IRS publications could provide a reasonable basis only if they are consistent with the plain language of the underlying tax code. So if you can't really rely on IRS publications for purposes of avoiding these penalties, particularly if the plain language of the code diverges from what the IRS publication says. A tax position has substantial authority. Now we're going to jump to the next standard. If the weight of the authorities supporting the treatment is substantial in relation to the weight of the authorities supporting contrary treatment. The types of authorities used to establish substantial authority are the same as those for establishing a reasonable basis. And so really the difference here is in regards to the amount of authority that's out there and the weight of those authorities. Not all authorities are weighted the same. For instance, the Internal Revenue Code weighted stronger than the regulations. Court cases might be weighted stronger than IRS statements. So there's different weightings to these. But generally speaking, you're just looking at the weight of the individual authorities on their own compared to the weight of all of the authorities that are out there. And so using that weighing of authorities, if the authority supporting the treatment is substantial in relation to the weight of the authorities against it, then you have substantial authority for a position. The final standard, which applies if the position relates to a tax shelter or listed transaction, is that the tax preparer, and this is the highest standard, must reasonably believe that the position would more likely than not be sustained on its merits. This means that there is a greater than 50% chance that the position would be upheld under audit or in court. It does not mean that the taxpayer has a greater than 50% chance of getting away with it by playing audit roulette. Generally, it is reasonable to believe that a position would be more likely than not sustained on its merits if the tax return preparer analyzes the pertinent facts and authorities and in reliance upon that analysis reasonably concludes in good faith that the position has a greater than 50% likelihood of being sustained on its merits. $66.94b provides a stiffer penalty for willful or reckless conduct by a tax preparer that results in an understatement of tax. This provision is given added significance because of the additional impact to the tax preparer under Circular 230, which can result in the tax preparer being disbarred from preparing taxes. Under 6694B, any tax return preparer who prepares any return or claim for refund with respect to which any part of an understatement of liability is due to willful or reckless conduct shall pay a penalty with respect to each such return or claim in an amount equal to the greater of A, $5,000, or B, 50% of the income derived or to be derived by the tax return preparer with respect to the return or claim. Willful or reckless conduct is described as a willful attempt in any manner to underestimate the liability for tax on a return or claim, or a reckless or intentional disregard for the rules or regulations. A preparer is considered to have willfully attempted to understate liability if the preparer disregards an attempt to wrongfully reduce the taxpayer's liability information furnished by the taxpayer or other persons. A preparer is considered to have recklessly or intentionally disregarded a rule or regulation if the preparer takes a position on the return or claim for refund that is contrary to a rule or regulation and the preparer knows of or is reckless in not knowing of the rule or regulation in question. Acting reckless in not knowing of a rule or regulation means the preparer makes little or no effort to determine whether a rule or regulation exists under the circumstances which demonstrate a substantial deviation from the standard of conduct that a reasonable preparer would observe in that situation. Notwithstanding these definitions, I know we're pretty heavy into the definitions here, but a tax return preparer is generally not considered to have recklessly or intentionally disregarded a rule or regulation if the position is contrary to the rule or regulation. If the position that is contrary to the rule or regulation has a reasonable basis and is also adequately disclosed. So once again, though, if there's a reasonable basis for it, you're not going to have reckless conduct. You can't be reckless as to a position when there's a reasonable basis for that position. So the Internal Revenue Code has a very specific prohibition against negotiating client refund checks, which is under IRC section 6695F. In this context, negotiating a check means a number of things, including endorsing the check, depositing the check, cashing the check. Those are all ways you negotiate a check. Of course, if you get a pay statement, for instance, and it says this is non-negotiable, this is a non-negotiable instrument, it's basically just a statement. You can't turn it in and cash it. So a negotiable instrument is a check, and negotiating it is cashing it, endorsing it, depositing. And so any check issued by the U.S. Treasury to a taxpayer that is your client, you cannot negotiate their checks on their behalf. The statutory language provides as follows. Any person who is a tax return preparer who endorses or otherwise negotiates, directly or through an agent, any check made in respect of the taxes imposed by this title, which is issued to a taxpayer other than the tax return preparer, shall pay a penalty of $500 with respect to each such check. The preceding sentence shall not apply with respect to the deposit by a bank within the meaning of Section 581 of the full amount of the check in the taxpayer's account in such bank for the benefit of the taxpayer. In other words, the taxpayer's bank can negotiate the check. That's kind of something that they have to do. So that last sentence is just to make sure that the banks are not being held liable under the statute for doing their job and taking care of the taxpayer's money and negotiating the check or truncating it. So each instance in which a tax preparer violates this statute by negotiating a tax refund check on behalf of a client results in a penalty of $500 per check. The language says that the taxpayer shall pay the penalty, and so it applies in all cases in which it is discovered by the IRS. Records of the client include all documents or written or electronic materials provided to the practitioner or obtained by the practitioner in the course of the practitioner's representation of the client that pre-existed the retention of the practitioner by the client. The term also includes materials that were prepared by the client or a third party, not including an employee or agent of the practitioner, at any time and provided to the practitioner with respect to the subject matter of the representation. Additionally, client records include any return, claim for refund, schedule, affidavit, appraisal, or other document prepared by the practitioner or his or her employer or agent that was presented to the client with respect to a prior representation, if such document is necessary for the taxpayer to comply with his or her current federal tax obligations. So, all these schedules that you prepare for the client are client records. However, client records do not include any tax return, claim for refund, schedule, affidavit, appraisal, or any other document pending the client's performance of its contractual obligation to pay fees with respect to such document. And the reason for this is you can imagine if there are these prepare penalties for not providing client records back to the client, and you can see how a client would abuse that because they could give you their records, have you prepare their tax return, and then say, yeah, you know what, I don't really want to pay you, but I know you're required to give me back all my records. So please give me all my records plus that tax return and those schedules and appraisals, etc., that you put together for me. Just give those back, and I'm not going to pay you. And then you'd have to give them their tax return. They could then file it, and then go to the next tax preparer next year who was unaware of their tactic. So that's why if you haven't been paid, you can retain those documents. They don't become client records until after you've been paid for the ones that you've prepared. However, that does not hold true for the client's records that they give to you. They give you their W-2s, their schedules, all their information. You have to give that back to the taxpayer, even if they never pay you for your services. Tax practitioners are required to maintain tax returns or lists of clients, including the client's taxpayer identification number, for all tax years prepared in the prior 3 years. Failure to maintain such returns or lists results in a fine under IRC Section 6695D of $50 for each such failure, up to a maximum of $25,000 fine per tax compliance year. At the request of the client, the practitioner must promptly return any and all records of the client that are necessary for the client to comply with his or her federal tax obligations. Practitioners also must furnish a copy of the taxpayer's tax return not later than the time the tax return is presented for the taxpayer's signature, and failure to furnish such a copy results in a penalty of $50 for each such failure under IRC Section 6695A, unless it is shown that such failure is due to reasonable cause and not due to willful neglect. The maximum fine per tax preparer during the calendar year for such failures is also $25,000. The practitioner may retain copies of the records returned to the client. The existence of a dispute over fees generally does not relieve the practitioner of his or her responsibilities regarding the return of client records. That said, if applicable state law allows or permits the retention of a client's records by a practitioner in the case of a dispute over fees, the practitioner need only return those records that must be attached to the taxpayer's return. The practitioner, however, must provide the client with reasonable access to review and copy any additional records of the client retained by the practitioner under state law that are necessary for the client to comply with his or her federal tax obligations. So once again, no matter what, the practitioner must return any of the records the client provided to the practitioner, like Form W-2s and 1099s. You cannot keep those. On the other hand, if it's something that was prepared by the tax preparer and they don't pay their bill, then so long as it hasn't actually been filed, once you've prepared and filed a tax return for a client, then that becomes the client records that have to be returned. But prior to filing a return, any preparation of items done are not typically records that must be returned to the clients unless the state law requires it. So e-filing is a really convenient way of submitting tax returns to the IRS, but it does pose some specific challenges. The topics that we're going to cover include the taxpayer's responsibilities related to electronic returns, e-filing signatures, and record-keeping requirements for e-filed returns. All of the prescribed due dates for filing of returns apply to e-file returns. They're no different. So, April 15th deadline is still the April 15th deadline. All providers must ensure that returns are promptly processed by those deadlines. However, a provider that receives a return for electronic filing on or before the due date of the return must ensure that it transmits the electronic portion of the return on or before the due date, including any extensions. And so an electronically filed return is not considered filed until the IRS acknowledges acceptance of the electronic portion of the tax return for processing. The IRS accepts individual income tax returns electronically only if the taxpayer signs the returns using a personal identification number or PIN. If providers transmit the electronic portion of a return on or shortly before the due date and the IRS ultimately rejects it, the provider and the taxpayer may comply with the requirements for timely resubmission of a corrected return. And the IRS considers the return timely filed as long as it's done before the due date. Slightly different with paper returns, though. As with an income tax return submitted to the IRS on paper, the taxpayer and paid preparer, if applicable, must sign an electronic income tax return. Taxpayers must sign and date the declaration of taxpayer to authorize the origination of the electronic submission of the return to the IRS, and this has to be done prior to the transmission of the return to the IRS. The declaration of taxpayer includes the taxpayer's declaration under penalties of perjury that the return is true, correct, and complete, as well as the taxpayer's consent to disclosure. Taxpayers may e-file on their own using a self-select PIN that can only be attained by providing their prior year AGI. Practitioner PIN is the other method and does not require the taxpayer to provide their prior year AGI amount. Although if you're a tax practitioner, you really should have the prior year return, so you would have that anyway, but either way, that's the way the system is set up in place. When using the practitioner PIN method, taxpayers must always appropriately sign a completed signature authorization form. This is Form 8879 in the case of 1040 returns. And regardless of the method of electronic signature used, after reviewing the return, the taxpayer must agree by signing the IRS e-file signature authorization containing the PIN. EROs should advise taxpayers to keep a copy of their completed tax return to assist with authentication in any subsequent years, just in case they will need their AGI, in case they do it on their own. Once signed, an ERO must originate the electronic submission as a return as soon as possible. EROs must not electronically file individual income tax returns prior to receiving Forms W-2 or Forms W-2G or 1099-R. If the taxpayer is unable to secure and provide a correct Form W-2, W-2G, or 1099-R, the ERO can electronically file the return after the taxpayer completes Form 4852, which is a substitute for Form W-2 or 1099-R. A year-end pay stub may not be used to file a tax return as a substitute for a W-2. So if you don't have the original W-2, you absolutely need to complete Form 4852. If they use a year-end pay stub to input that information, really that's on the taxpayer. But you as a tax preparer should not put yourself, expose yourself to potential penalties by relying on a pay stub. So you need the taxpayer to complete Form 4852 and represent to you that information is correct. And then it's no longer on you because you're relying on an original document. That's just like a W-2 or a 1099-R as far as you're concerned. If the IRS rejects the electronic portion of a taxpayer's individual income tax return for processing and the ERO cannot rectify the reason for the rejection, the ERO must take reasonable steps to inform the taxpayer of the rejection within 24 hours. When the ERO advises the taxpayer that it has not filed the return, the ERO must provide the taxpayer with the reject codes accompanied by an explanation. If the taxpayer chooses not to have the electronic portion of the return corrected and transmitted to the IRS, or if the IRS cannot accept the return for processing, the taxpayer must file a paper return. In order to timely file the return, the taxpayer must file the paper return by the later of the due date of the return or 10 calendar days after the date the IRS gives notification that it rejected the electronic portion of the return or that the return cannot be accepted for processing. Taxpayers should include an explanation in the paper return as to why they are filing the return after the due date. In this case, the explanation will be that you submitted an electronic return, it was rejected, it could not be accepted for processing through the e-file method, and so you're filing the return within 10 days, and that's your explanation. The ERO must retain Forms 8879 and 8878 for 3 years from the return due date, or the IRS received, or the date that the IRS received the return, whichever is later. EROs must not send Form 8879 or 8878 to the IRS unless the IRS requests they do so. Tax preparers who prepare tax returns for compensation, which is how you define tax preparers under the Internal Revenue Code, are required to sign the returns they prepare and furnish their PTIN on each such return. Failure to do so results in a $50 penalty for each such occurrence. This means if a tax preparer prepares tax returns for compensation and does not sign the return and does not provide their PTIN, there's a $100 fine based on this particular statute. And as I mentioned, the definition of a tax preparer under IRC 7701 is used for purposes of these penalties, which means the tax preparer must prepare the return for compensation in order for the penalties to apply. An ERO must also sign each return they file, but they do so using their PIN. EROs should use the same PIN for the entire tax year. For returns prepared by the ERO firm, return preparers are declaring, under penalties of perjury, that they reviewed the returns and they are true, correct, and complete. EROs may authorize members of their firms or designate employees to sign for them, but the EROs are still responsible for all electronic returns originated by that firm. For returns prepared by other than the ERO firm that originates the electronic signature or the electronic submission, the ERO attests that the return preparer signed a copy of the return, and the electronic return contains tax information identical to that contained on the preparer return. So sometimes you have individual tax preparers who are not EROs and they work with EROs to file those returns. So in those instances, that's really what we're talking about here. In such cases, the ERO is simply attesting that the electronic submission they did is the same as their tax return, and the tax return has a signature by the preparer on it. The ERO also must enter the return preparer's identifying information, and this includes the name, address, EIN, when applicable, and PTIN otherwise, in the electronic return. EROs may sign Form 8879 and 8878 by rubber stamp, mechanical device such as a signature pen or computer software program, and the rules for those signatures are found in Notice 2007-79. The signature must include either a facsimile of the individual ERO's signature or of the ERO's printed name. EROs using one of these alternative means are personally responsible for affixing their signatures to returns or requests for extension. This does not alter the requirement that taxpayers must sign Form 8879 and Form 8878 by handwritten signature. So even though you're e-signing the return, even though you're submitting e-signatures on the returns or on the forms, you still have to hand sign them. All right, so now we're going to take a look at refund and payment options for taxpayers. It seems pretty simple and straightforward, but it's still something that apparently the IRS has had challenges with. And so we're going to go through these fairly basic concepts, but it's also, you may learn something new here if you aren't used to getting very creative with your refund options, and that's not atypical. Usually people just utilize one refund option, but if you want to utilize others, this section is going to teach you all about it. So in such instances where the sum of the taxpayer's withholdings, estimated payments, prior year carryforwards, and all of their tax credits exceeds the taxpayer's total tax liability, the taxpayer has an overpayment of taxes, and the taxpayer's return will constitute a claim for a refund. And alternatively, if the sum of these amounts is less than the taxpayer's tax liability, then the additional tax payment is due with the tax return. But what we're going to focus in on is when a refund is due on a tax return. A taxpayer has 4 separate options where an overpayment has been made and a tax refund is due with the filing of the taxpayer's return. 1. Apply the overpayment to the next year's estimated payments. 2. Request a refund of the overpayment via paper check. 3. Request a refund of the overpayment via direct deposit to the taxpayer's bank account, which can include a checking, savings, or retirement account. And or 4. Use the overpayment to purchase U.S. Series savings bonds. A taxpayer may also apply the overpayment among each of these different options and even split direct deposit amounts among different bank accounts, including a retirement account. The default refund option is to receive a paper check in the mail, and so if the taxpayer merely indicates that the overpayment should be refunded without providing any additional information on Form 1040, then the taxpayer will receive a check in the mail at the taxpayer's mailing address indicated at the beginning of the taxpayer's return. A paper check tends to be the slowest option for receiving a refund, as it requires, once the return is processed, it's going to require an additional delay for the IRS to process, print, and mail the refund check. The taxpayer may receive a tax refund by direct deposit into one account by inserting the routing number, account number, and account number directly, account type and account number directly on the Form 1040. If the taxpayer desires to have the entire refund applied as an estimated payment, the taxpayer may do so on Form 1040. The taxpayer may also have the refund split between a direct deposit and estimated payment by indicating the proper amounts directly on Form 1040, which must combine to equal the total amount of the refund due. Alternatively, the taxpayer must fill out Form 8888 if the taxpayer wants to 1. Split the refund among multiple bank accounts, 2. Have the refund applied to purchase up to $5,000 of savings bonds, 3. Split the refund among one or more of these options, or 4. Split the refund into any 2 separate refund payments, such as a direct deposit payment and a paper check. The taxpayer may request up to 3 savings bond registrations, but each registration must be a multiple of $50, and the maximum of all such registrations cannot exceed the smaller $5,000 or the taxpayer's refund amount. Direct deposit tends to be the quickest way for a tax refund to be paid to the taxpayer, and the IRS has indicated that the majority of direct deposit refunds are paid within less than 26 days. There is a specific process where the taxpayer can track the processing of their refund check or their refund deposit through the e-file system. And this is found on the IRS's webpage. Taxpayers should be directed to the Where's My Refund section of the IRS's website for more information, as you might have taxpayers that are really interested in knowing exactly when their refund is coming, and for those really anxious taxpayers that you have and those clients, it's best to get them familiar with the e-file system so that they can get that information that's readily available for them. There are a few instances that can preclude a refund that might otherwise be due from being paid out by the IRS. First, the refund must be requested prior to the expiration of the statute of limitations period for filing a claim for refund under IRC Section 6511. So if they file a claim for refund and the statute of limitations is passed, that refund is going to be rejected even though it might otherwise be due. Second, if the taxpayer has past due amounts owing to the IRS related to other tax periods, then the IRS may apply the refund to such past due amounts. If the taxpayer owes past due federal taxes and the taxpayer's refund is offset by the IRS to pay the tax, the past due amount will be deducted first from any refund or direct deposits requested. And if they requested multiple direct deposits, then the deduction will be in reverse descending order as in the order stated on Form 8888. And sometimes that's an issue because oftentimes tax refunds will be split among spouses who are separated or about to divorce. And so which spouses, if they have past taxes due, taking that method and splitting that may result in one of the spouses paying for that and not the other. And we're going to talk in a minute about innocent spouse, more or less innocent spouse relief for joint filers. But you just need to be aware that if there are past taxes due, the lowest listed direct deposit bank account is going to be hit first until it's all paid off. And if that doesn't cover it all, go to the next one up and the next one up until the whole refund's gone. Then presumably they'll reduce any other allocations of the tax refund like bonds or future estimated payments, but they're usually going to start with the direct deposit payments. In addition to past due taxes, the Treasury Department's Financial Management Services, or FMS, may offset refund amounts due based on garnishments for past due state income taxes, child support, spousal support, or certain federal non-tax debts such as student loans. FMS will send a notice containing the original amount of the refund claimed, the amount of the offset, and the agency receiving the payment with its contact information. If the taxpayer wishes to dispute the debt resulting in an offset, then the taxpayer should contact the office in the notice directly rather than contacting the IRS itself. So whatever agency is mentioned in that FMS notice, that's who you need to go to if you want to dispute the debt. In instances where a taxpayer files a joint return and is not responsible for the debt that is used to offset the tax refund, the taxpayer may separately request their portion of the refund by filing Form 8379, Injured Spouse Allocation. Now, it's important to get this right because if you don't do this correctly, then you could have the debt offset the spouse's refund that they're entitled to. And so it's important that you follow the process just right, because even if you file that form, sometimes if you don't do the process correctly, they'll still offset it anyway. So if you file the joint return and you're not responsible for the debt, but your taxpayer is entitled to a portion of the refund, the taxpayer may request that portion of the refund by filing 8379, either with the original return or separately if it comes up after the original return has been filed. If you file this with the original return, the IRS has indicated the taxpayer should write injured spouse at the top left of the Form 1040 so that the IRS will process the request prior to applying any offsets. So that's just an important aspect. Paper return, write injured spouse at the top left. If Form 8379 is filed by itself, then it must include the Social Security numbers for both spouses in the same order as they appear on the Form 1040. Once again, this is to match it up. They want to make sure the 8379 matches up with the Form 1040. So if you're completing one separately from the 1040, maybe after the fact, then you need to utilize the Form 1040 and make sure side by side they're exactly the same. Again, this is a processing issue. At the end of the day, if an injured spouse, an innocent spouse, is entitled to get the refund, they're eventually going to get it. But you don't want them to eventually get it. You want them to get it right away, and you want them to not be subject to an offset up front, because then their offset goes to some other office within the IRS, or not within the IRS, but within the federal government, and you have to track that down. It's a huge pain. It'll take a long time, so you want to do it right the first time. The injured spouse must sign the form and send it to the IRS Service Center where the original return was filed.